Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here. Investor Coaching Show, Paul Winkler. Talking money and investing. Okay, so walking through some myths of investing. If you don't know these myths are out there, you're gonna be subject to them. It's super easy to get people pulled in, when it comes to these myths because they feel that our instincts and our emotions. Our instincts are go toward pleasure, go away from pain. And I often taught a workshop where I would go, I plus E is greater than C. And then what I would do is I'd add to that. I is your instincts. My instincts go toward pleasure. I really feel good about this. This sounds good. Those, and then emotions. This feels really good. It sounds, I trust these people. They're well known. My employer uses them for their 401k. And I'll often point out some of the biggest mutual fund companies that run 401ks, they'll have literally over 1,000 different mutual funds. A lot of them, they'll use these individual accounts, these separate accounts that you can actually manage your own portfolio. And they'll say, we'll give you 9,000 to 10,000 mutual funds. And you go, well, wait a minute. We're going to give you access to 9,000 to 10,000 different mutual funds in your 401k? How many funds do you really need if you know what's going to happen next? That's just ridiculous. It's just information overload, but it's opportunity overload. And they just give you access to everything so you can hang yourself. It's kind of the way I look at it. So often the way things are, to simplify it, just choose based on track record, right? Well, let's look back through history. And let's just say we got the track record. We've already established that the professional managers don't repeat. We've talked about that they'll try to pick which companies out of the large U.S. companies are going to be the best going forward. And they may get lucky, but they don't repeat is what we find. Well, what about areas of the market? Now, this is something that my friend, business owner, 401k, his employees coming up to him and saying, can't we just put, I've got this S&P 500 fund and it's done so well. Can't we just do that? And he says, you don't want to do that. Well, let's go back to the late 90s. And, you literally, when we talk about large companies, small companies, large value companies, small value companies, international large companies, international small companies, if you look at from 1970 going forward, you look at say, well, how often did large U.S. stocks was that the best returning of the area, best returning area of the market? It wasn't in 1970, nor was it in 71, 72, 73, 74, 75, 76, 77, 78, 79, 80. You get the point, right? It wasn't the top performing area of the market in any of those years. It wasn't in 1981, 82, 83, 84. It took all the way until 1989 before that was the top performing area of the stock market. And that's the one you hear in the news all the time. You hear about the Dow, you hear about the S&P 500, you hear about the NASDAQ, you hear about large US. But literally, we're going from 1970 all the way to 1989 before it was even the top performing area of the market. And go, wow. Well, did it continue to go on and do well? Well, no. 1990 it wasn't. 1991 it wasn't. 1992 it wasn't. 1993 it wasn't. 1994 it wasn't. 1995 it wasn't. Where are we? We're on the mid-90s. You remember kind of the tech bubble? Even still, the S&P 500 was not the top performing area of the market. It didn't hit top performing status until 1998. That's when we started hearing about it. We started hearing about large companies and tech companies and these great, wonderful, growth companies at that point in time. Now, the funny thing was it didn't even repeat in 1999. Small companies were the top performing area that year. Then you go to 2000, and what happens? It goes down 9%. 2001, down 12%, down 22% the year after that. And, in the year 2000, you had value companies up 10 plus percent, during that particular year. And then years like, you get to about 2003, and nobody's talking about large U.S. Nobody's talking about it anymore. Nobody, you couldn't give the stuff away. It didn't hit top performing status again until 2014. Not until 2014 was it the top area of the market of all the ones that I named. Then go forward, and 2 years in a row, 2023 and 2024, the S&P 500 was the top performing out of those 6 asset categories that I named. 7, actually, because I had microcaps in there now that I think about it. So if you look at that and go, wow, why is it that we hear about that all the time? It's because those companies are the most familiar to you. And we call that familiarity bias. We're biased towards things that we recognize. And let's face it, everybody recognizes who Apple, Nvidia, and Amazon, and large companies like GE and Coca-Cola. We recognize those companies. We know who they are. We shop there. We buy their stuff. So that's why these indexes are so well known, is because it's all the indexes of big companies. But recognize, as I said, you didn't have the top performing status till 1989, and then not till 1998 again, and then you had to wait all the way to 2014, and then 2019, and 2023, 2024. So this is the issue with past performance. Now, because it's recent history, 2023 and 2024, now you have another psychological bias, and it's called recency bias. And investors, folks that would be, dealing with the 401ks and things like that, and employees of companies would be enamored with large U.S. stocks. Why? 2 reasons. Recently, they had done well. Now, not in 2025, not comparatively. They did okay. But, there were other areas of the markets that did way, way, way better. And so far in 2026. But nobody hears about them. Nobody talks about them. But here's the thing, is that number 1, good past performance. Number 2, extremely low cost to manage. And that's what gets people's attention. And mutual fund companies know that if they say, hey, something's low cost, let's say something's on sale at Kroger, or something's on sale at Home Depot, or whatever, that it will attract your attention. And if you can combine that with good recent past performance, you got a marketing message that will sell. So that's basically what's going on here, is our instincts go toward pleasure, and then our emotion, I guess emotion, yeah, it'd probably be emotion. Get one over on the man. I want something for nothing. I want something cheap. I want something, because I want to be seen as a smart consumer, especially if I'm talking to my friends and, I go up and say, oh yeah, I've got a really low cost investment portfolio and I'm really, and, we want that. I mean, who doesn't want to feel like, that people respect them for their level of knowledge and prowess and, investing and wow, you're really smart. You do that. I read about that in, XYZ financial magazine. You seem sophisticated and people like that. But the reality of it is, just recognize that it's marketing and maybe somebody's getting one over on you. This is why I think the education process is so important. Is once you understand this stuff, I find that the people that I've taught over the years, they come back and go, wow, this just makes so much sense. And I can't get my friends to listen to what I have to say. And I was like, well, yeah, you're running an uphill battle. It's hard for me to get people to understand this stuff, and let alone you being a layperson trying to explain it to them. So I get it. All right, I'm going to take a quick break and be right back after this. I'm going to continue on with just another myth of investing. I want to walk through Well, a couple of them. A couple of things I think are really important. We have this tendency as Americans to be very U.S.-centric. And that can be a huge mistake. So I'll walk through that a little bit right after this. You're listening to the Investor Coaching Show.
Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax.
All right, back here on the Investor Coaching Show, Paul Winkler, talking money and investing. Just walking through a couple things, when we talk about market timing, that's another myth. I hadn't hit that a whole lot. Market timing is the idea of changing an investment portfolio based on a prediction about the future. What do you think is going to do well in the future? We talked about how stock picking doesn't work, right? And you look at market timing, it's bad. The results, there was a study that was done on that going back the year in 2023, active funds versus benchmarks. And they're engaging in this type of management. And it was, again, 90% in one area of the market, 100% in another area of the market. Let's just cursory look at this one, 89.09%. 91.3% in another asset category, 75% for municipals, and they're just not doing very well as far as figuring out where markets are going to go. But you'll see these fund companies do these charts. They'll have this looking at charts and trying to figure out how to analyze the market and looking for head and tails patterns and head and shoulders patterns. Excuse me. And you can't make heads or tails of it. That's where my head was going. But they don't do very well. I mean, it's just pretty bad, but yet people think that the media has this ability to do that because they turn to the media, they turn to these professionals for predictions to protect themselves against what might be coming. It's appealing to think that maybe somebody knows what's coming next, so I can protect myself from it. And then when there's a workshop I teach, I go back to the 1930s and I go through the 1940s and I go back to the 1970s and I go through different decades, and I show that the investment industry's never been able to do this. They've never been able to figure this stuff out. There's one that's really kind of funny. It was the New York Stock Exchange CEO, and he's asked about what he thinks is going to happen in the stock market in 2009, and he says, well, the big money investors were really cautious in March, and they think another rally is going to happen in June or July. And the thing that I like to point out is they missed the March upturn, which was 8% for large U.S. stocks and 11% for small in 1 month. They missed that. Well, if they're not going to get back until June or July, they missed the April upturn in large stocks of 9% and 24% for small companies. And they're not going to, in May, they missed that because they're not going to get back in until June or July, according to him, the smart money, or the real money investors is what he calls them. So they missed May, presumably, that went up another 5%, another 11% for small companies, for a total combined missed return of 25%, almost 26% for large, and 53% for small. And you go, wow, if that's what the real money investors do, what the fake money investors do. And when you'll see this kind of stuff, you'll see, there's an article that was in Market Watch talking about a 1-2-3 punch could drop stocks 30% in 2016. And they had all kinds of good reasons why that would happen. Yet small caps went up 28% and large companies went up 12%. So their ability to time the market is just abysmal. It's really bad. And why? Because nobody knows what the news is. And news is what drives stock markets. That's really it. And one of the things that happens with the investing industry is they have so much to gain. You look at the management fees on your mutual funds and you think that's the sum total of all your expenses. And often what I'll point out is, no, that's not it. There are all kinds of other expenses in the investing process you're probably not even aware of. Bid offer spread costs. You have survivorship bias is another kind of a different type of an expense. You have what happens to securities lending revenue, what happens to momentum, and how does that affect expenses? How do mutual funds, are they paying any commissions? You can have commissions inside of things. How are they routing the orders? How is the investment firm routing the orders? Are they going to the lowest cost market maker out there? Do you even know that? Do you know if that's what's happening? How about the hidden expense of lost opportunity cost because a portfolio, an index fund, overweights bigger companies versus smaller companies? Or they overweight growth companies in the portfolio versus value. And 96% of 20-year periods, value does better than growth. I mean, you got a pretty good shot that maybe overweighting the wrong area can be a problem. What if they're not rebalancing on a timely basis, or they're not rebalancing in the most efficient manner? So when I rebalance a portfolio, if I have 10% of my money in one area of the market and 10% in another area of the market, I don't always want to go and rebalance unless the deviation from the target is big enough that the expected benefit outweighs the cost. Well, is that being done? And most people sit there and shake their head and go, I don't know, I hope they're getting that done right. And I'm going to tell you, when I worked for the big investment firms, and literally every one of us, Evan, Jonathan, Jim, Arlene, Dan, all of us, we all worked for the big investment firms and different types. Some banks, some worked for mutual fund companies, some worked for insurance companies, some worked for the big brokerage houses. But the reality of it is, we never talked about that stuff. I didn't have a clue it existed. If it hadn't been for my penchant for just going and getting as informed as I possibly could about investing, because I felt it was my duty, I wouldn't have known about it. Now you know a little bit more about it.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.